In the late 1980s, Japan was the envy of the world. Its companies were buying American landmarks, and its economy seemed unstoppable. By 1989, the market capitalization of the Tokyo Stock Exchange accounted for over 40% of the world's total equity value. It felt like Japan had found a new, permanent way to achieve infinite growth. At the heart of this frenzy was the bubble economy. Japan had a unique system where banks, large corporations, and the government were deeply intertwined, often cross-owning each other's shares. This created a cycle where businesses could borrow cheaply and invest aggressively, inflating the value of assets like land and stocks to levels that defied logic. Consider this: at the peak of the bubble, the land under the Imperial Palace in Tokyo was theoretically valued at more than all the real estate in California combined. It wasn't just optimism. It was speculative mania fueled by incredibly low interest rates and a belief that prices in Japan would never, ever go down. But gravity eventually caught up. Worried about rampant inflation, the Bank of Japan decided to prick the bubble by sharply raising interest rates between 1989 and 1990. The cost of borrowing spiked, making it impossible for companies and individuals to keep fueling the speculative fire. The crash was swift and brutal. The Nikkei 225 stock index, which had reached nearly 39,000 in December 1989, began a free fall. Within 2 years, it had lost more than half its value. Investors who had poured their life savings into the market watched as trillions of yen simply evaporated into thin air. The property market didn't fare any better. As stock prices plummeted, companies that had used their inflated land holdings as collateral for loans found themselves in deep trouble. Banks were left holding bad loans, debts that could never be repaid because the underlying assets were now worth a fraction of their original value. This created what economists call zombie companies. These were firms that were technically insolvent but kept alive by banks that didn't want to admit their losses. By keeping these inefficient firms on life support, the Japanese economy couldn't reallocate resources to new, productive industries. The growth engine had stalled. The government attempted to stimulate the economy with massive public works projects, building bridges, roads, and dams in rural areas. While this kept unemployment low, it failed to jumpstart private investment. Japan fell into a liquidity trap, a situation where people hold on to cash because they expect prices to fall further, halting spending. This led to the era known as the lost decades. Instead of a quick recovery, Japan dealt with persistent deflation. When prices drop year after year, consumers delay purchases, and businesses stop investing, creating a vicious cycle of stagnation that lasted well into the 2010s. The human cost was significant. A generation of young professionals entered a job market that had no space for them. The lifetime employment model, which had defined Japanese corporate culture since the post-war era, began to crumble, leading to a rise in precarious contract labor. Beyond the finances, the cultural impact was profound. The Japanese dream of constant upward mobility was replaced by a more cautious, minimalist lifestyle. The optimism of the 80s was replaced by a society focused on preserving wealth rather than creating new industries, as the demographic clock began to tick towards an aging population. The lesson from Japan is clear: bubbles are rarely just about individual greed. They are systemic failures where regulators, banks, and corporations collectively lose sight of fundamental value. When an economy relies too heavily on rising asset prices rather than real productivity, the eventual correction is never just a dip, it's a fundamental reset that can last a lifetime.